Charlie Munger once said, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid." Most investors are obsessed with getting rich fast, chasing the next hot stock, or trying to time the market. But Munger's approach was different. He wasn't looking for brilliance. He was avoiding stupidity. This single mindset, avoiding big mistakes and never losing money, quietly made him a billionaire. In today's video, we'll break down Charlie Munger's #1 rule, explain why most investors fail to follow it, and show you exactly how to protect your money and grow it wisely, the Munger way. What Charlie Munger really meant by never lose money. When you hear someone say, never lose money, it sounds impossible. In the world of investing, losses are everywhere. Stocks go up and down every day, markets crash, businesses fail, and unforeseen events can wipe out wealth overnight. Most people hear this phrase and think it's a promise of risk-free investing. But Charlie Munger never meant it that way. Munger's philosophy is much deeper than avoiding temporary losses. It's about avoiding permanent destruction of capital. Let's break that down. Temporary loss is what every investor experiences. You buy a stock for $100, and it drops to $80. It hurts, but if you hold the investment and the fundamentals are strong, the value can rise again. This is normal market behavior. And smart investors understand that short-term fluctuations are irrelevant in the grand scheme. Permanent loss, on the other hand, is catastrophic. It's when your capital disappears completely. Money that can't be recovered. This can happen when a business fails completely. Fraud destroys your investment. Leverage amplifies mistakes. You make decisions without understanding the asset. Munger emphasized that investors should never put themselves in situations where permanent loss is possible, even if it means giving up potentially large gains. This mindset is counterintuitive in today's world of get-rich-quick schemes and hype-driven investing. Most people chase high returns and ignore the real risk, losing what they already have. Charlie Munger himself said, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid." Notice he doesn't say, always be brilliant, or pick the next winner. His edge was in avoiding stupidity and protecting capital, not in discovering the hottest investment. In simple terms, the rule is, protect first, grow second. Why losing money is mathematically dangerous. The idea of never losing money might seem overly cautious until you understand the math behind it. Losing money isn't just an emotional problem. It's a mathematical problem. Let's take a simple example. Suppose you have $100,000 invested. You make a mistake and lose 50% of your capital. Now you have $50,000. To get back to your original $100,000, you don't just need a 50% gain. You need a 100% gain. That's because gains are calculated on the new, smaller base. $100,000 lose 50%, $50,000. To get back to $100,000, need 100% gain. $50,000 times 2 equals $100,000. This demonstrates why avoiding losses is far more important than chasing gains. Even small mistakes compound over time and make recovery exponentially harder. Time is another critical factor. Wealth isn't just about numbers. It's about time in the market. Every year your capital is at risk is a year of lost compounding. If you lose a significant portion of your portfolio, it doesn't just set you back in dollars, it sets you back in time, which is far more valuable. Charlie Munger understood this principle better than almost anyone. He saw that protecting capital early in your investing journey allows compounding to work quietly and powerfully over decades. Conversely, reckless risk-taking can destroy years of compounding, making it nearly impossible to achieve long-term wealth. This principle is why Munger often avoided speculative investments. He didn't chase hot trends, fads, or short-term gains. Instead, he focused on staying in the game, preserving capital, and letting time do the work for him. In Munger's view, the single most important aspect of investing is survival. If your capital survives, you have the opportunity to grow it. If your capital is destroyed, no amount of brilliant picks can bring it back. Think about investors during market crashes like 2008. Those who survived did so not because they were exceptionally smart or lucky. They survived because they didn't take catastrophic risks. Those who borrowed heavily, chased trends, or invested in businesses they didn't understand often lost everything. In essence, Munger's rule is mathematical and logical. Avoid large losses at all costs, because recovery is exponentially harder than avoidance. Avoid stupidity. Munger's real competitive advantage. Charlie Munger didn't rely on being a genius. In fact, he often says that intelligence alone is not enough to succeed in investing. What set him apart was his ability to avoid stupidity, the mistakes most investors make without realizing it. It's remarkable how much long-term advantage you get by trying to avoid being stupid. This may sound simple, but it's profound. Most people spend their lives chasing brilliance, trying to pick the next big stock or timing the market perfectly. Munger spent his life trying not to make mistakes that could destroy his wealth. So, what does avoiding stupidity mean in investing? Avoid businesses you don't understand. Never invest in something you cannot analyze or comprehend. If you don't understand the business model, risks, or fundamentals, it's easy to make catastrophic mistakes. Avoid leverage. Borrowing amplifies both gains and losses, but it's the losses that are dangerous. Even the smartest investors can fail if they are over-leveraged. Avoid following the herd. Just because everyone is buying the latest hot stock doesn't mean it's safe. Social proof can be dangerous in investing. Avoid overconfidence. Many investors think they can predict the market or pick winners consistently. Munger understood that consistency and caution beat brilliance in the long run. Avoid impulsive decisions. Emotional investing is deadly. Panic selling, greed-driven buying, and impatience lead to mistakes. Munger's discipline ensured he avoided these errors. By consistently avoiding these errors, Munger created a huge competitive advantage. While others lost money through mistakes, he preserved capital, allowing compounding to work quietly in his favor. In a way, this rule is more powerful than any stock-picking technique. It's a mental model for survival in the investing world. You don't need to be the smartest person in the room. You need to avoid being the most foolish. Munger's approach was simple but profound. If you survive without major losses, your chances of building wealth increase dramatically. This philosophy is counterintuitive in a world obsessed with chasing the next hot investment. Yet, history proves it works. Buffett and Munger built their empire not by gambling on the latest fad, but by avoiding catastrophic mistakes, staying disciplined, and applying common sense consistently. Permanent loss of capital. The only risk that matters. Charlie Munger's genius lies in his clarity. The only risk that truly matters is permanent loss of capital. Many investors waste time worrying about small daily fluctuations in stock prices, thinking they are at risk. Munger's perspective is far more focused and rational. Temporary losses, a 10%, 20%, or even 30% drop in the market, are irrelevant if your investment fundamentals are strong. The danger lies in investments that can permanently destroy your money. This could be due to business failures, excessive leverage, fraud, or ignorance of what you're buying. Consider leverage. Borrowing money to invest may magnify gains, but it also magnifies losses. A bad decision when you're leveraged can wipe out your capital entirely. Even brilliant investors have been ruined by over-leveraging. Munger understood this, which is why he avoided speculative borrowing. Another example is investing in businesses you don't understand. Many people are drawn to trendy sectors, tech startups, cryptocurrency, or exotic financial products, without fully grasping the risks. When these ventures fail, investors lose money permanently, and unlike temporary market dips, you cannot recover this loss without starting over. Fraud and mismanagement are also silent killers. Even if a business appears solid, mismanagement or deceit can drain your investment. This is why Munger emphasizes thorough analysis, understanding the business, and staying within your circle of competence. Munger often stresses, focus on survival first. If your capital survives, growth will follow naturally. If it's destroyed, even the most brilliant investment strategies are useless. This mindset turns the abstract concept of risk into something tangible and actionable. Never put yourself in a position where you could lose money permanently. Margin of safety. The practical tool behind the rule. Now that we understand permanent loss is the true enemy, how does Munger protect against it? The answer: margin of safety. The margin of safety is a simple but powerful concept. It means buying high-quality businesses at reasonable prices, leaving room for error and unexpected events. Even if the company underperforms temporarily or the market drops, the margin of safety ensures your capital is still protected. Think of it like wearing a seatbelt. You hope nothing bad happens, but if something does, the seatbelt reduces the damage. In investing, the margin of safety cushions you against mistakes, volatility, and uncertainty. For example, Munger preferred companies with strong and predictable cash flows, durable competitive advantages, minimal debt and clean management, clear, understandable business models. He avoided chasing the cheapest stock or trendy investment. Price matters, but quality matters even more. You want a business that will survive and thrive over decades, not a quick, flashy winner that could collapse tomorrow. Munger also understood that perfect valuation doesn't exist. You can never predict exactly how a business will perform, but the margin of safety allows room for uncertainty. If you buy solid businesses at reasonable prices, even mistakes in your assumptions won't destroy your wealth. This principle is at the heart of Munger's rule. By always applying a margin of safety, he minimizes risk and ensures that losses are controlled or avoided entirely. Over time, this cautious approach compounds into massive wealth, quietly and reliably. Why most investors break this rule repeatedly? Even though Munger's rule is simple, most investors fail to follow it. Why? Because human psychology, social pressures, and emotions make it hard to protect capital consistently. Here are the main reasons investors break the rule. Overconfidence. Many people believe they can pick the next big winner. They think they are smarter than the market or their peers. This overconfidence leads to risky bets and ultimately losses. Herd behavior. People tend to follow the crowd. If everyone is buying a stock or chasing a trend, they do too, even if they don't fully understand it. This often leads to buying at inflated prices and suffering permanent losses when the trend reverses. FOMO, fear of missing out chasing hot investments, is a fast track to mistakes. Investors see others making quick gains and panic about missing out. They jump into opportunities without analyzing the risks. Emotional decision-making. Fear and greed are powerful forces in investing. Panic selling during a market drop or chasing returns during a rally can destroy wealth. Munger's discipline allowed him to stay rational and patient, avoiding emotional pitfalls. Ignoring fundamentals. Many investors focus on price movement, trends, or news instead of the underlying business. They buy a stock because it's popular or the chart looks good, not because it's a solid company. Ignoring fundamentals leads to catastrophic mistakes. History proves this over and over. During market crashes, those who focused on survival and fundamentals, like Munger and Buffett, came out ahead. Those who chased trends, borrowed money, or acted impulsively often lost everything. The key lesson is simple. Protecting your capital requires discipline, patience, and rational thinking. It's easy to ignore when markets are soaring, but ignoring it is what leads most investors to failure. Munger's brilliance is not in making perfect predictions but in being consistently cautious, avoiding mistakes, and staying out of trouble. By following this approach, he built wealth steadily, quietly, and reliably, a process that continues to reward patience and prudence. Leverage. The fastest way to break Munger's rule. One of the quickest ways investors destroy wealth is leverage. Borrowing money to invest. At first glance, leverage seems like a shortcut to faster gains. You invest $100,000 of your own money and borrow another $100,000. If the investment rises 10%, you double your profits. Sounds smart, right? But here's the catch. Leverage doesn't just amplify gains, it amplifies losses too. Imagine that same investment drops 10% instead. Your $200,000 total investment is now worth $180,000. You lose $20,000 on $100,000 of your own money. A 20% loss instead of just 10%. Multiply that by larger swings and your capital can evaporate very quickly. Even brilliant investors can go bankrupt using leverage. History is filled with examples of smart individuals who lost fortunes during market crashes because they borrowed heavily. Leverage introduces risk of permanent loss, which directly violates Munger's #1 rule. Munger understood this. He rarely used leverage except when it was extremely safe and predictable. His investments were chosen for stability and reliability, not excitement. In fact, he once said, "The first rule of compounding is never interrupt it." Leverage interrupts compounding faster than almost anything else. If your capital is destroyed or heavily reduced, no amount of market recovery or brilliant stock picks can make up for it. Lesson for the viewer: avoid borrowing to invest. Focus on protecting the money you already have. If you want to grow your wealth, do it with patience, discipline, and intelligent choices, not shortcuts that can ruin you. Patience, the silent partner of never losing money. Patience is one of the most underrated aspects of successful investing. Most people view it as passive, something you do while waiting for better opportunities. But in Munger's philosophy, patience is active protection. Why? Because every decision you make has a chance to go wrong. By waiting for clear, obvious opportunities, you reduce the likelihood of mistakes. Less action often equals fewer chances to lose money. Munger and Buffett often waited years before buying a business at the right price. They didn't rush. They didn't panic if a stock dropped 10% or 20%. They waited for situations where the risk-reward ratio was overwhelmingly in their favor, and the business fundamentals were strong. Patience also reduces stress. Investors who panic sell or chase returns often make emotional, destructive decisions. Munger's patience allowed him to remain calm during market volatility. By staying disciplined, he avoided losing money unnecessarily. Consider real-world examples. During the tech bubble in the late 1990s, many investors rushed to buy internet stocks. Prices soared, everyone was excited, and people believed fortunes were just a few clicks away. Munger ignored the hype. He waited. The bubble burst, and those who chased the trend lost massive amounts of money. Those who were patient and avoided stupidity survived and prospered. Patience, in Munger's view, is not passive. It's strategic protection of capital. By doing nothing until the right opportunity arises, you preserve your wealth and let compounding work quietly and effectively. Real-world examples that prove the rule. Theory alone is not enough. Let's look at real-world examples that demonstrate the power of Munger's rule. Example 1. Buffett and Munger during the 2008 crash. During the 2008 financial crisis, markets plummeted. Many investors panicked, sold their holdings at rock-bottom prices, and lost years of wealth. Buffett and Munger didn't panic. They didn't chase short-term gains or follow the herd. Instead, they focused on quality businesses with strong balance sheets. Their patience and discipline protected their capital, and when the market recovered, their wealth grew even larger. Example 2. Investors who followed hype. On the other hand, consider the dot-com bubble. People invested heavily in companies with no profits, no business model, and sky-high valuations. When the bubble burst, many investors lost everything. These losses were permanent. The difference: those who avoided stupidity and preserved capital survived. Example 3. Margin of safety in action. Munger and Buffett invested in Coca-Cola and See's Candy. They didn't buy because the stocks were cheap today or because everyone else was buying. They invested because they understood the businesses, valued them sensibly, and had a margin of safety. These decisions were not glamorous, but they avoided losses and grew wealth consistently. These examples highlight a fundamental truth: survival first, growth second. Munger built his fortune by avoiding mistakes that could destroy capital. Others lost fortunes chasing short-term wins or following market trends. Why this matters for you? You don't need to pick the next Amazon or Tesla to succeed in investing. You don't need to be brilliant. You only need to avoid permanent losses, exercise patience, and focus on quality investments with a margin of safety. Following Munger's principles allows you to stay in the game longer than most investors, and time is your greatest ally in wealth creation. The longer your capital survives, the more opportunity it has to compound quietly and powerfully over the years. How an average investor can apply this rule today. Charlie Munger's #1 rule, never losing money, may sound simple, but applying it consistently is where most investors fail. Here's a practical step-by-step guide that anyone can follow. 1. Understand what you're investing in. Never invest in anything you don't understand. This is called staying within your circle of competence. If you can't explain how a business makes money, what drives its profits, or what risks it faces, don't touch it. Many people invest in trendy sectors or complex financial products without understanding them, and that's how permanent losses happen. Munger avoided this trap by only investing in businesses he could analyze thoroughly. For example, he didn't speculate on exotic investments or hype-driven stocks. He stuck to simple, understandable companies with predictable earnings. 2. Avoid borrowing money to invest. Leverage may seem tempting, but it's the fastest way to break Munger's rule. Borrowing amplifies both gains and losses. Even brilliant investors can be ruined by leverage. Instead, focus on investing your own capital, preserving what you already have. Growth comes from patience and compounding, not from risky shortcuts. 3. Focus on capital preservation, not excitement. Most investors chase flashy returns or hot tips. Munger teaches the opposite. Protect your money first. Ask yourself before every investment, can I lose this money permanently? Is the risk reasonable compared to the potential reward? Does this fit within my circle of competence? If the answer is yes to permanent loss, skip the investment. Preservation comes before profit. 4. Use margin of safety. Always leave room for error. Buying a quality business at a reasonable price allows for mistakes, market fluctuations, and unexpected events. For example, investing in a business with strong brand loyalty, clean management, and predictable cash flows gives you a margin of safety. Even if the market dips, your investment survives and grows over time. 5. Be patient. Patience is a core part of avoiding losses. Don't rush into investments just because the market is hot. Wait for clear opportunities where the risk is low, the fundamentals are strong, and the margin of safety is wide. Fewer decisions often lead to fewer mistakes. Munger didn't feel pressure to act every day. He waited years if necessary for the perfect opportunity, and that patience protected his capital. 6. Avoid emotional decisions. Fear and greed are the enemies of wealth. Panic selling during market drops or chasing short-term gains leads to permanent losses. Stay rational, disciplined, and focused on the long term. Munger's philosophy is simple. Don't let emotions dictate your investments. Consistent, rational decisions are far more effective than trying to beat the market with impulsive actions. 7. Keep your portfolio simple. Simplicity reduces risk. You don't need dozens of complicated investments to succeed. Munger and Buffett preferred a few high-quality holdings that they understood well. A concentrated, well-understood portfolio reduces the chance of mistakes and helps you protect capital, reinforcing the #1 rule. 8. Learn from mistakes and history. Munger emphasizes learning from both personal mistakes and the mistakes of others. Studying past market crashes, failures, and successes helps you avoid common pitfalls. Permanent loss often comes from repeating mistakes that could have been avoided with foresight. Knowledge is another layer of protection. Summary of practical steps. To apply Charlie Munger's #1 rule today. Invest only in what you understand. Avoid borrowing to invest. Focus on protecting your capital. Use margin of safety. Be patient. Avoid emotional decisions. Keep your portfolio simple. Learn from history and mistakes. Following these steps won't make you rich overnight, but it will protect your wealth, give compounding time to work, and create consistent long-term growth. Exactly the way Munger built his fortune. Charlie Munger's approach is deceptively simple. It doesn't promise flashy gains, quick wins, or market timing. Its power lies in discipline, rational thinking, and survival. By focusing on avoiding permanent losses, applying margin of safety, and exercising patience, Munger created wealth quietly and reliably. He didn't need to gamble on trends or speculate wildly. He simply avoided mistakes that most investors make. Remember, protect your capital first. Avoid stupidity and impulsive decisions. Be patient and disciplined. Focus on long-term quality investments. These principles are timeless. The investors who follow them survive, thrive, and watch their wealth grow steadily over decades. Those who ignore them risk permanent losses and years of lost opportunity. Charlie Munger's #1 rule is not just about investing. It's a way of thinking, a framework for decision-making, and a path to financial survival and freedom. Follow this rule consistently, and you'll not only avoid catastrophic mistakes but also position yourself for wealth that compounds quietly, safely, and powerfully.